fourth week of June 2025. And fair to say, it wasn't exactly the kind of market that people expected. And specifically, things were pretty quiet going into the weekend. Then over the weekend, President Trump unexpectedly, or at least earlier than expected, sent the so-called US bunker busters in to bomb and disrupt the Iranian nuclear enrichment sites. Now, what you can see here is the unexpected part. Over the weekend, there was a little bit of consternation, but actually early signs that the markets were going to take this reasonably well. Egypt up on Saturday, the Israeli market up on Sunday. And what we've seen the last few days is especially emerging markets, actually, funnily enough, up by almost 3%, the US market up by 2%, and even the Australian market up almost 1%. And meanwhile, you've seen gold come off. So that sort of, crisis premium coming down. And probably the most unexpected one, arguably, was gold. Was the oil price, which was up by 20% in the preceding weeks, reaching a bit of a hiatus over the weekend, and the last couple of days falling back by 20% back to where it started. That's all we're really going to talk about as far as markets are concerned, but it looks like a fairly strong finish to the financial year. But the thing we wanted to talk about, and there's a bit of a segue into something that we promised last week, which was to take this quite complex view of forward-looking return expectations, the investsense valuation dashboard, and this idea that there's sort of some financial gravity that comes home to roost, and you can position in a certain way even if you're not really sure what happens in the short term. And that's something that we talk about in this forum quite a lot, because it's good to look out the front window and to be aware of what's going on. But what we think really drives returns, or the easier thing to position for, is long-term risk premiums, and that's quite a complicated thing to get across to clients. So as we promised last week, we're going to try and reduce this into terms that perhaps you as an advisor could use with clients. Now, this is the point I wanted to start on, that short-term market moves are very difficult to predict. And it's to do with this concept of reflexivity, that there's so much expectations in markets that sometimes the exact opposite of what people expect is what happens, because there's so much expectation built into there. And that's one of the things that drives this slightly perverse behavior. Now, clients of ours will know that we were quite overweight in the UK by the end of 21 and underweight the US. But what we couldn't have predicted was the Ukraine war and the impact that would have on the UK market, which was one of the only markets that provided positive returns in 2022. And it wasn't necessarily because the UK did anything spectacularly different. It was because it was cheaper than everything else, and that afforded a degree of stability when things got a little bit rocky. But more generally, this is one of the charts that we showed last week, and what this is showing is expected returns according to a slightly techie framework, but basically, what are the cash flows, what are the yields, and how are they expected to develop over the future? Now, if something's really expensive, it might stay that way and it might continue to grow. But if something changes, well, it could go the other way. Now, what we had here was after the GFC, we had US stocks like Apple and Microsoft trading on very low multiples, but still growing, but actually looking quite cheap. So that gave you a very high expected return. Meanwhile, emerging markets in green here were trading at very high multiples, and there was a lot of growth in the area, but it was just waiting for the winds to change and expectations to change, and then perhaps some negative investor sentiment. And then the expected returns start to climb, and the process of that happening is basically negative or moribund returns. The opposite of which for the US, as people have regained confidence in the US over the last 15 years, and that concept of US exceptionalism has really taken hold, the multiple that people would pay for US equities has decreased. But also it means that the expected returns going forward have also decreased. And you can see these little pressure points when you get down to about sort of 2% or not very much at the end of 2021. And then you had that reset. And then we've had a couple of good years, and we've had a little bit of a reset again this year. That data is to March, end of March of this year. So that takes us to the hero of the story. And CBA It's now 12% of the local market. So if you've got 30% in Aussie equities, it's actually 3% of your portfolio, which might be a similar allocation as a fund, for instance. Clients of ours can see, you can't read all the letters here, but if you got this up on our portal, you'd see this is a sort of bird's eye view of a diversified portfolio. This big green blob is the 30% or so in Australian equities. And if I was to just draw what CBA would represent of that, it would be about 3%, which is going to be about that much. And you can see down here in international equities, we've got a few funds there. You won't be able to read what they are, but basically it's like investing in a fund, and you should sort of pay the same kind of attention to that. But it also provides an interesting way of explaining to clients potentially in terms that they understand with a stock that they might be very familiar with, that if you apply exactly the same methodology, this is using a framework supplied by UBS called Holt, and it gives you the same expected return when you put everything together, the dividends, how much the cash flows are expected to grow by, and what happens if people normalize their expectations of how much they should pay for that stock to a historical average. So it's got what's called mean reversion. If you put all those things together, you get to a sort of 1% per annum over the long term. Now, that's obviously not a great outcome. And it doesn't help you get to your CPI plus 2 or 3 or 4 or whatever you're sort of pitching for. And this isn't just us coming up with a funny old model that's predicting this outcome. There's a large consensus in the market, and what this red area is showing is all the sell recommendations by sell-side analysts, and they tend to kind of hedge their bets. They don't want to stick their neck out too much. And you can see back here, this yellow line is the actual stock price, and the white line is how much they collectively think CBA is worth. And you've got this big disparity, which is about 50% of the current price. And no one can, basically the maths don't stack up. So what gives? How can there be so much compelling evidence that CBA is so overvalued? Well, it's a mixture of factors. It could be the passive bid. It could be momentum, people buying it because it's gone up. It could be overseas investors. There's all sorts of theories out there, but there's a simpler one. And George Soros used to say he was a fundamental investor, very valuation driven, but a lot of his success came from rowing against some of these things. And he used to say, when you find a bubble, don't try and pop it. You're not bigger than the market. Blow into it. And so, that is a strategy, and that's what a lot of people in the market are doing. But you've got to be quite careful because you're holding this thing that could pop at any time. And there's another old market saying from John Maynard Keynes, an economist from 100 years ago, or who said roughly in the 20s or 30s, came up with this saying, which is very much related to these concepts. Be careful because the market can stay irrational, i.e., maintain a price at a fairly irrational level for longer than you can stay solvent. And certainly there is some evidence to that, but as an individual investor or as a portfolio manager, maybe that's the battle you've got to fight. And if you see something really expensive, you've got a choice to make there. Another market saying is sometimes things are a bug looking for a windscreen. And that's the way that we think if you've got a long-term time horizon, you can take measured bets against these things. And this is the chart that we think is potentially consumer friendly because it talks about this pendulum effect, things going from expensive to cheap and then back again, and sometimes, not all the time, they rest in the middle, and that's when things are sort of like at fair value. But what this graph really shows is that there's a degree of instability. When things get really expensive, they can only stay there for so long, and then they swoop down and maybe they overshoot and go the other way. Another way to get this point across might be just to look through the prism of yield. So most investors will understand that they maybe own CBA as an income stock, and when it was yielding about 5%, so you held the stock and you got 5% of your capital back in income, especially when rates were super low, that seemed like an okay deal. But everyone knows that CBA is a bank. It's unlikely to grow its earnings very, very fast. And especially in an environment where people have already borrowed quite a lot, they're probably quite constrained. But most of all, down at a 2.5% yield, you need something else. You need some earnings growth. So if people suddenly decide, well, actually, I'm not getting the income, maybe I should just hold cash, or anything else, or REITs, or maybe the broader market or other banks, and get something more like 4 or 5%. Well, if everyone decided that at the same time, you'd get your halving in value. So that's a much simpler way of saying that it's probably approximately 50% overvalued. On the other side of the spectrum, we've got things like CSL, and I've used the same chart from this Holt framework, which shows that when you put all those things together, the current dividends, how much you expect them to grow by, and whether they're cheap or expensive. And you can see that CSL was a market darling back before pre-COVID, and it consistently traded more and more expensive until you had a bit of this reset. And again, it was a bug waiting for a windscreen. But now you're getting to the point where this is in real terms 3%, you add 2 or 3% inflation, and you're getting a respectable long-term return. But you look at something like Treasury Wine Estates, again, a previous market darling, very low expected returns. You've had this reset, especially recently, and you're now getting to potentially in nominal terms, add a bit of inflation to that, sort of double digits long-term expected returns. And you put enough of those things together, because clearly this isn't a stock recommendation because there's risks associated with each of them, but you put enough of those together and you own less CBA and you own more of these things, and you start to see a way that you can achieve your retirement objectives. So hopefully, especially with reference to this chart, that might give you a narrative that you could potentially talk to some clients about in the context of a stock that they probably know very well. And lastly, we'll just leave you with a sneak preview of what we're going to talk about next week, which will be dissecting the returns performance for different types of investments for the financial year 24-25. And you can see the takeaway is that passive funds have outperformed. There's been a bit of volatility. There's been some ups and downs, but we finished on a little bit of an up, which means that if you're, for instance, in a 70-30 portfolio, you've done 10%, but you've had, a few near misses along the way. So if you look at that in risk adjusted terms, actually, everything's pretty much line ball. But if you're just looking at it in returns, passive has probably done better given where we've ended up. And we'll also talk a little bit about how the industry funds have done compared to that, and what the drivers have been, and what the outlook is for the next financial year. Look forward to talking then. Thank you.